Then the last type of decision that we need to look at is decision making under conditions of risk and uncertainty. So guys, sometimes we need to make decisions, but we are dealing with an uncertain business environment. And because we're dealing with an uncertain business environment, we don't know for a fact what's going to happen in the future. So we might have a situation where we have several different or several possible outcomes. So let's look at the example below so that you can see what I'm talking about. In this example, I've given you information for Colorful Stuff Pty Limited. They have the choice of manufacturing either product A or product B. And I've given you the information below for both product A and for product B. Now, this is what I mean by an uncertain business environment. We can see for product A, they think that there's a 5% chance they will make a 4,000 Rand profit, a 10% chance they will make a 6,000 Rand profit, 40% chance they will make an 8,000 Rand profit, 25% chance they will make a 10,000 Rand profit, and a 20% chance that they will make a 12,000 Rand profit. So because the business world is uncertain, the company doesn't know for sure. If they start manufacturing product A, they don't know exactly what's going to happen. They can't say with certainty, next year we will definitely make a profit of 10,000 Rand, because they are dealing with an uncertain business environment. So what we do, guys, is you can see there are several possible outcomes. Over here, we had 5 different things which could happen. So what the company does in order to perform calculations is we assign probabilities to all of the different outcomes and we calculate an expected value. So you can see they have assigned probabilities. They told us the percentage chance of us achieving that certain profit. Please, what's important to note is the sum of your probabilities should always add up to 1 or 100%. And then all we do is we are going to calculate an expected value or an expected profit. And it's a really simple calculation. You just take the profit and you multiply it by the probability. So 4,000 times 5%, 6,000 times 10%, 8,000 times 40%, etc. You get the point. Take the expected outcome, multiply it by the probability, and get your expected profit. So if we are required to perform any calculations for product A, we're going to use the expected profit of 8,900 Rand in our calculations. So we saw this company has the choice of product A or product B. So let's see what they've told us about product B. With product B, there's a 50% chance that they'll make a loss of 4,000 Rand and a 50% chance that they will make a profit of 22,000. So the sum of your probabilities always adds up to 1 or 100%. And then we need to calculate an expected profit. And we calculate that by taking the outcome, multiplying it by the percentage, and you get the weighted outcome. If we add those together then, it gives us a total of 9,000 Rand. So product A gives me an expected profit of 8,900 Rand, and product B gives me an expected profit of 9,000 Rand. So if we just look at the expected profits, it seems like product B is the better product because it's giving me a higher expected profit. Okay, it's only 100 Rand difference, but it's a higher expected profit. Now looking at this logically, before we even read on any further, I want you to tell me which of these products is more risky. Is it more risky for the company to manufacture product A, or is it more risky for them to manufacture product B? Now look at the worst case scenario for each option. For A, worst case scenario, they make a profit of 4,000 Rand. Best case scenario, they make a profit of 12,000 Rand. For B, worst case scenario, they make a loss of 4,000. Best case scenario, they make a profit of 22,000. Which product is more risky, product A or product B? Product B is more risky because with product B, we have the chance of making a loss. With product A, the worst case scenario is a 4,000 Rand profit. So B is much more risky because with B, there's a chance that I make a loss. With A, worst case, I make a smaller profit. However, remember also the relationship between risk and return. We already said product B is more risky. And because it's more risky, in bad times, there's a chance of making a loss because it's more risky. However, in good times, you can see it will outperform product A because the best case scenario over here is a profit of 22,000. Whereas with product A, the best case scenario is a profit of 12,000. So because A is less risky, there's no chance of making a loss. However, because it's lower risk, the potential for returns is also lower. So we can see best case scenario has a lower profit. Product B is more risky because there's a chance we can make a loss, but because it's more risky, there's also the potential for much higher profits. So remember the relationship between risk and return. More risk is compensated through a higher expected return. So the company now needs to decide, are they going to go for A or are they going to go for B? So you can see if we discuss this just below, product B has a higher expected profit than product A, but there is greater uncertainty attached to product B. So this was the more risky product. And why is there more uncertainty? Because of the greater variability in possible outcomes. So what do I mean by that? If I look at product A, the difference between my best and my worst case scenario is a difference here of 8,000 Rand. That's the difference between a 4,000 Rand profit and a 12,000 Rand profit. However, if we look at product B, I've got a difference here of 26,000 Rand. That's the difference between a 4,000 Rand loss and a 22,000 Rand profit. So you can see the differences between the best and the worst possible outcome. So you can see B, product B, has a greater difference or greater variability of the possible outcomes. It has a greater difference in the possible outcomes, and that makes it more risky. So there's a greater degree of uncertainty. There's more risk attached to product B because of the greater difference or the greater variability in the possible outcomes. Now guys, we have already analyzed this in detail just by using logic. By calculating this expected profit, I can see product B has the higher expected profit. However, we can also see because of the difference in the outcomes, product B is more risky. There's a chance of making a loss, but there's also potential for a much higher profit. Using logic, we can see product B is more risky. However, we are now going to use statistics in order to prove that product B is the more risky product. And you do need to be able to perform these calculations. So we are going to calculate the standard deviation and the coefficient of variation. Now guys, both of these are measures of risk. So the reason why we perform both of these calculations is to measure risk. The only difference between the two is the standard deviation is an absolute measure, meaning it is a total amount. And on the other hand, the coefficient of variation is a relative measure, meaning it is a percentage. So the difference between the two is the standard deviation is a total amount, meaning it can't be used for comparisons. However, because the coefficient of variation is a percentage, this can be used for comparisons. So let's do the two calculations and then you guys can see what I'm talking about. So first, let's look at product A. And for product A, we are going to calculate the standard deviation and the coefficient of variation. So you can already see the standard deviation is a total amount. It's an absolute amount. It can't be used for comparisons. Whereas the coefficient of variation is a percentage. It's a relative amount. It can be used for comparisons. Let's look at the actual calculation. Now, we have already calculated this expected value. where you take the outcome and you multiply by the probability in order to get the expected value. And we saw for product A, we had an expected profit of 8,900 Rand. So that's all I'm populating my next column with. You just take that expected value and you complete that column. Now, you guys will know in all of the lectures I've covered with you to date, I never tell you to just learn a rule. This is the rule, learn it, and that's what you do. In Manak, you always need to understand what you're doing. This is the one time where I'm just going to tell you to learn a rule. Because we're dealing with statistics over here, the chances of this being asked at a psycho level is extremely low, guys. This isn't a competency that's required of a chartered accountant to be able to calculate deviations and all other statistical calculations. However, UNISA has been known to ask this in the past, which is why I'm covering it. I don't want to leave it out because if they ask it, this can be worth quite a few marks. So we need to cover it. However, please note this is very statistical. The calculations can all be done on your financial calculator. You don't even have to draw up this table. However, if UNISA asks this, please, you must draw up the table because there are going to be marks allocated for drawing up the table. So this is the one time where I'm going to say to you, learn the table, learn the calculation. After this, I'll show you the logic behind what we've calculated, but please don't worry about how this calculation actually works. It's very statistical. It is nothing you're going to be required to do as a chartered accountant. So this is one section where I'm going to tell you just learn. So learn this table that I've got. You start the table with the outcome. You take the probability. You work out an expected value. You then complete the next column with the expected value. Then let's look at the next column. What we're doing in the next column is we are saying R, which is my outcome. So R minus this expected value gives me that. 6,000 minus 8,900 gives me that. 8,000 minus 8,900 gives me that, etc. You can see the calculation. Okay. You're taking the outcome and you're subtracting the expected value. Please note it's not these individual expected values. Each time you're subtracting the total expected value of 8,900 Rand. Then all you do is you square that. So you say negative 4,900 squared and you get your answer for each one. You just take that whole column, you square it. Then all you do, guys, is you are going to multiply this amount by the probability so that you can get your final answer. Okay, so once you've worked out R minus the expected value, you square that. You then multiply it out by the probability, and that gives you your expected deviation squared. If I then sum that, it gives me 4,590,000. Now, please note that is not my standard deviation. That is my standard deviation squared. So I need to put that into my calculator and I need to get the square root of that so that I can calculate my standard deviation. And that then gives me the standard deviation. An absolute measure, a total amount, it can't be used for comparative purposes. Then the calculation of the coefficient of variation is very simple. All we do is we take the standard deviation that we calculated above and we divide by our expected profit of 8,900 Rand. And you get your answer as a percentage. Okay, let's just recap. We need to do the same calculation for product B. So as a recap, study this table off by heart so that you know how to work out the standard deviation. You take your outcome, you multiply it by the probability, you get your expected value. You take that expected value and you populate the next column. Then what do? We take the outcome and we minus the expected value in order to get R minus EV. 22,000 minus 9,000 gives me 13,000. Then we square that. So negative 13,000 multiplied by negative 13,000. Positive 13,000 multiplied by positive 13,000. Square it. You then take that squared amount and you multiply it by your probability so that you can get your expected deviation squared. So remember, that gives you your deviation squared. If you want your standard deviation, you need to get the square root of that amount, and that will give you your standard deviation. Then finally, we need to calculate our coefficient of variation. You just take that standard deviation that you calculated above and you divide by your expected value of 9,000. And this gives you an answer as a percentage. So let's wrap this up. We already said when we looked at this logically that the more risky product was product B. And now I said to you, by calculating the standard deviation and the coefficient of variation, these are just measures of risk. So how it works, guys, is you can't compare the standard deviations because those are total amounts or absolute values. So we can't compare those, but we can compare the coefficient of variation. And you can see that product B has a much higher coefficient of variation than product A. And that means that product B is riskier. So you can see in the conclusion below, therefore, product B is riskier than product A because of the greater variability of possible outcomes. So remember, we have discussed this already. We said that just means there's a greater difference in the possible outcomes. So B was more risky than A, and that's why it's sitting with a higher percentage over there, because there's a greater coefficient of variation. There's a greater difference between the possible outcomes. So what should the company do? If they are risk averse, so they don't want to take any risks, then they should invest in product A because that was less risky. Alternatively, if they would like to take the risk for the chance of higher returns, because remember we saw product B did give us potentially higher returns, then they should invest in product B. So product B might be more risky, but there is also the chance of making much higher returns. Now guys, throughout this lecture, we have looked at everything from a financial perspective. We looked at a make or buy decision, a discontinuation decision, joint and buy products, whether they should be sold at the split off point or processed further, special orders, how should they be priced. We've looked at everything from a financial perspective. However, you already know at this point in your studies that when we're making decisions, we can't only look at things from a financial perspective. We also need to consider qualitative or non-financial factors. So just below you can see it is essential that qualitative factors are also considered during the decision-making process. Otherwise, there is a danger that the wrong decision will be made. So in addition to the financial figures, consideration must also be given to other issues with the ultimate goal of sustainable value creation. So when making decisions, we need to consider our impact on the environment, our impact on people or social impacts, and also governance considerations. So guys, I've included an example just below to make sense of what I'm talking about. The very first type of decision we looked at was a make or buy decision. Now, I want you to assume it's more expensive for the company to actually manufacture the product themselves than it is to purchase from an outside supplier. So they've done the financial calculation and they can see it's cheaper to actually buy from an outside supplier and it's more expensive if they manufacture the product internally. But the company might still decide to manufacture the product internally because these qualitative or non-financial factors might override the financial calculation. So for example, they might consider qualitative factors such as, if we outsource, that's going to lead to retrenchments. And that will obviously have negative social implications because we're now retrenching our staff. In addition to that, the employees that remain behind, there's definitely going to be a decline in their morale, which could affect our future productivity or our future output, because those employees are obviously going to be worried about the security of their job in the future. What if they also get retrenched? In addition to that, if they outsource, the company will no longer have control over the quality of the product. So if they're worried about the quality of the product being an issue if they outsource, because remember, if customers aren't happy with the quality of your product, you're going to lose customers to the competition if you don't uphold your standards. So what they might do is they might say, It's definitely cheaper for us to buy from an outside supplier and more expensive to make it internally. However, when we take these qualitative factors into account, the cost savings might be insufficient in order to cover the risk of the qualitative factors. So they might still decide to rather manufacture the product internally, because then they don't have to worry about retrenchments, they don't have to worry about the decline in employee morale, they don't have to worry then about substandard quality products being produced by the outsourcing company. Now, linked to that, guys, let's look at some exam technique points. Firstly, please read the required carefully. So this isn't specific to decision making. Obviously, you always need to read the required carefully. So what normally happens if they ask you decision making in a test or an exam is they ask you to perform the financial calculation first. So in part A of the question, for example, you do the financial calculation where you work out, is it cheaper to make the product internally or outsource and buy from an outside supplier? You do the financial calculation. And then in part B, they might ask you to discuss qualitative factors. So read the required carefully, because either the required is specifically going to ask for qualitative or non-financial factors, or what it could do is it could just ask for factors to be considered. Now, guys, a mistake that's often made by students, and this sounds very obvious, that's why I just want to point it out to you, is when the required asks for qualitative or non-financial factors, people still discuss costs. Please note, you cannot discuss costs if the required specifically wants qualitative or non-financial factors. So read the required carefully. If they don't want you to discuss costs, then you cannot discuss anything relating to costs. If the required wants qualitative or non-financial factors, then you are looking at the social implications of retrenchment, the effect on your employee morale, the effect on the quality of the product. Those are all qualitative factors. But you cannot discuss the cost of retrenching your employees, for example, because then you are discussing costs and not qualitative factors. But read the required carefully, because in some questions they're very specific. In some questions they say discuss qualitative or non-financial factors. Then you cannot discuss costs. However, if the required is more open and it just says discuss the factors to be considered, then you need to discuss both qualitative and quantitative factors. So both financial and non-financial factors. So read the information carefully. And I'm saying this, like I said to you already, it sounds obvious, but I've marked papers, guys, where people write, and I'm not joking, 90% of students write an entire page of cost information. And I cannot award 1 mark because you are talking about costs instead of qualitative factors. So please read carefully. Then in addition to that, when we are discussing things, don't focus only on the negative. So above, I focused only on the negative of outsourcing. The negative being the retrenchments, the employee morale, the quality of the product might change. The positives I haven't taken into account. And as accountants, for some reason, we tend to focus more on the negative factors and not the negative and the positive factors. So please note, when you're looking at questions, if there is anything positive that you can bring into your discussion, you must also bring positive factors in. They aren't only asking for the negative. What are other things the company must consider? That's not just negative things. It's anything else they must consider, both positive and negative things. So avoid being too negative. Then, guys, it is not a memory dump. Your discussion must be relevant to the scenario. And that's why you can see in our lecture notes, I haven't given you a list of qualitative factors. For each type of decision, I haven't listed qualitative factors because you cannot study a list of qualitative factors. It must be relevant to the information that was provided in the question. So at this level, you need to be able to read information that UNISA provides you with in your test or your exam, analyze that information, and give advice based on what you are told in the question. Not a list of qualitative factors that you saw in another question or that you picked up from undergrad or something like this. Okay, so it's never just a memory dump. There's no marks allocated just for random things you've seen on other solutions. Whatever you write down must be relevant to this specific scenario. Also, take a look at a UNISA suggested solution. Remember, your goal is to try and come as close as possible to the UNISA suggested solution. They never have long paragraphs. They write short sentences, short bullet point sentences, not long-winded paragraphs. Don't overwrite. And that's actually linked to the next point there just below. If something is only worth 5 marks, you write down 5 or 6 or 7 bullet points. I understand why you want to write more. You're scared that what you've written down you're not going to get marks for, so you want to add more. So if you can think of 7 points, write 7 points. But please do not write 2 pages of information in order to try and score 5 marks. There, you're not thinking. You're just writing without thinking. And at a CTA level, you have to be able to think. So rather use your time more wisely to plan your answer. Think a little bit, plan your answer, and then only write down enough to score you the 5 marks. Okay. Let the mark allocation guide you so that you know how much or how little you need to write. If something is for 30 marks, then obviously you need to write down a minimum of 30 points. Okay. But let that be your guide. And then lastly, guys, your tone must be professional at all times. Don't bring emotion into your answer. Even if it's something that is relevant to you in your personal life, don't bring emotion into the answer. Again, look at a UNISA suggested solution. It's professional. They stick to the facts. You stick to the facts, short, concise, bullet point answers. Keep professional at all times. All right. That then brings us to the end of this lecture. Thank you, guys.